Hello and welcome to the Money Marketing Podcast. I'm Lois Vallely, Chief Reporter, and this is the second in a special three-part series brought to you in association with Prue, examining key trends in the market and how they're affecting different aspects of financial services and planning. For this episode, I'll be joined by Cat McInally, Business Development Manager at Prue, to explore investment smoothing and smooth funds. Hi Cat, thank you so much for joining me today.
Hi there.
Could I start by sort of asking you to tell our listeners a bit about yourself and your role at Prue, please?
Sure. Warm welcome from myself at Prue. So I've worked at Prudential as a business development manager on the investment side now for best part of 15 years. So I've been around since Prudential launched our very first smoothed Prue fund back in 2004 during previous stints at Prudential. So long experience of working with smoothed multi-asset style investments.
Great, that's perfect, because in this podcast we're going to be discussing the process of investment smoothing and how it can sort of help mitigate against short-term volatility. So I think maybe first up it might be useful to talk a bit about what investment smoothing actually means for any of our listeners who don't know. I don't know much about it, so I'm going to be interested to hear a bit about what it is and what are some of the ways it can be done.
Okay, sure. So when we talk about smoothing at Prudential, we talk about it with two guises. So the first part of smoothing is multi-asset investing. So we all know the rhyme, the reason. If you don't put all your eggs in one basket, if you diversify your money across different assets, then over time you'll get a nice smooth return, because some of those assets will perform when others don't, and vice versa. So by diversification, you get an element of smoothing in your funds, and that's what we call multi-asset investing. The other type of smoothing that we offer at Prudential is at a product level, and that is where we smooth out the returns for clients by giving them a proportion of an expected return, and that expected return is based on a long-term outlook of what we would expect those multi-assets that we invest in to deliver.
Okay, that's interesting. So could you talk me a bit sort of through that process? If an investor wants to smooth their investments, what sort of happens?
Sure. So smoothing is only available from Prudential under tax wrapper. So you would invest into our smooth funds either through an ISA, a pension, or a bond. So once you go into the appropriate tax wrapper, effectively what we do at Prudential is we tell investors up front what we would expect those smooth funds to grow by, and that's what we call our expected growth rate. And effectively that is our long-term outlook on what we think all those different assets will deliver. When I say long term, I'm looking at sort of 10 to 15 year outlook. So that's the starting point. We tell clients up front, this is what we expect these funds to grow by. So what we then do is, rather than clients have a sort of a daily unit price, which you see with all other multi-asset funds, is we smooth that daily price out. So they get a proportion of that expected growth rate added to their fund value every day. So over time, they see a sort of smooth performance rather than sort of what we would call sort of a daily unit price, where you see that sort of jaggy line. So that's the first element of smoothing. And then obviously we know, and hopefully all advisors know, that no fund goes in a straight line up all the time. That would be the panacea of investments, and smooth funds, not even that is possible. So what we do within the Prue fund range is we do daily checks to start with, to make sure it's not falling out of sort of smoothing corridors daily. And then with the newer versions of Prue fund, depending on what version you're in, we either do monthly checks or quarterly checks, where again we have the smooth price, you have your unsmooth price, and then there's smoothing corridors at either side. So if the unsmooth price hasn't breached those smoothing corridors at the checkpoints, then again the fund will just continue to grow by that expected growth rate. If we've experienced market volatility either up or down, and it has breached those smoothing corridors, and those smoothing corridors will differ depending on what version of the fund you're in, then we will either do an adjustment, and that adjustment will either either be upwards if the fund, if the unsmooth fund has done better than the smooth fund, or downwards if the unsmooth fund is below that smooth fund. And what we do at that point is we then adjust the smooth price so it's in line with clients' expectations.
I see, yeah. So it probably works quite well at the moment because I think we're in quite a sort of volatile period in stock markets. So what are some of the sort of key benefits of smoothing, especially at a time like we're in at the moment?
Yeah, absolutely. So right now, when we are experiencing sort of market volatility, that's when smooth funds can become appealing to a lot of advisors for their clients, and clients likewise like the fact that a lot of that day-to-day volatility, they don't see that, they just see that smooth line. But what we're always very careful in telling advisors is that smooth funds are not immune to market volatility. If you have severe market volatility, if you think of smoothing as a short-term protection from day-to-day market volatility, but in any severe market volatility, so if you go back to the COVID-19 crisis where we first had that the downwards sort of falls in the marketplace, we experienced downwards unit price adjustments at that point to reflect the underlying fund performance and underlying markets. What you tend to find is you get a little bit more protection on the downside because markets tend to be sort of quite volatile on the downside. But on the upside, when markets recover, you have to remember that if markets recover very quickly, the smooth funds will always lag that rapidly rising market because you're getting a proportion of expected growth rate, and then you either have quarterly or monthly checks on that. So people need to understand that smoothing provides you with a degree of protection on the downside, but also it can lag a rapidly rising market on the way back up.
I see. Yeah, no, that sounds like just something to be aware of. Then it's not actually doing worse, but it might look like it is on the face of it.
It's a long-term investment is what we always like to remind advisors, that the sort of smoothed style funds, whether it's from ourselves or other providers, they're designed to be invested for the longer term, not really sort of a quick in and out smoothing, and in that scenario probably isn't going to work for your clients.
Yeah, no, I see. I can totally understand though, because I remember when the COVID pandemic first hit and my shares took a massive tumble, and I was very tempted to take them out, but I know that's just the worst possible thing, or to sell them, sorry, that's the worst possible thing you can do. But I can understand why clients might panic if they sort of see massive drops in the market. But it sounds like smoothing can really help with that. Then are there any sort of specific clients that this process works best for, or do they need to have a certain amount of money or be investing in certain things?
So I suppose just back to that, obviously for the longer term. So it works well for a number of guises. Smoothing is used an awful lot for clients taking an income, especially in retirement, because if you've got that smooth line, especially where you've got volatile markets, where markets are sort of dipping like they are currently, if you take an income from a smooth fund, it can give a better outcome than taking income from a fund that's falling. Just like what you said there, clients want to get out the markets when their investments are falling, whereas actually that's the worst possible time you could take your money out. One, you crystallize a loss, and then two, the fund's got to work even harder. If you're taking an income out and it's fallen in value, then you need an even better upturn in the markets to actually make that loss back up, because you've taken income on top of that loss. So we find a lot of advisors use us in the retirement space. Also, at retirement, if you've got clients who have accumulated quite a large pot of income for their pension in retirement, and ultimately we used to have the old lifestyling where you would start to disinvest out of equities and move that money into fixed income or cash, and right now is probably not the best time to be moving into fixed income and cash with inflation and interest rates, etc. So that can prove challenging. So we find a lot of advisors will use us in that space for sort of a lifestyling strategy. Again, the smoothing can help with that. In the intergenerational side of things, if you've got clients who maybe want to do some IHT planning and they want to move the money to the next generation, the aim is that you actually leave money to the next generation rather than, obviously go into sort of, high risk equities. And then when it's the grandchildren's time to receive their inheritance, well, market volatility is taking care of that and there's not much left. Might not have an IHT problem, but obviously you want to move money down to the next generation. And actually where we start to see the smooth funds being used a lot in that space is the planet range, so the more ESG style solutions, which is what we see evidence of. The younger generation are more interested in the likes of ESG style funds, and last year we launched an ESG range, which has been quite popular in the sort of intergenerational planning side of things.
Okay, that's interesting. Are there any disadvantages of smoothing or sort of pitfalls that investors and advisors need to be aware of?
I would say, again, really understanding what smoothing is and how it works would be absolutely key for anyone who's investing in a smooth fund, to absolutely understand how smoothing works. That example we spoke about earlier on, in 2020, where we saw that really quick market recovery after COVID-19, the markets recovered really quickly. Again, because of the smoothing overlay on our multi-asset funds, that recovery we saw was much slower. So, you got a proportion of expected growth rates, and then you would have to wait for your monthly or your quarterly checks to see if you would get an uplift or not. And we have absolutely caught back up with the market and some. However, that's taken a longer process than say some of the unsmooth multi-asset funds out there. So just really understanding, we always say, smoothing can provide you, it lags a falling market. So when the markets fall or are volatile like they are now, we can provide a degree of protection through that, but it also lags that rapidly rising market as well. So just to be mindful, you're in it for the long term. You're going to get a proportion of that expected growth rate added every single day, rather than the sort of the daily fluctuations of bog standard markets.
I see. Yeah, so it smooths out the troughs, obviously, but it also smooths out the peaks and to make them look less exciting, as well as the troughs look less scary.
Yeah, I think as well with smoothing, and the way that our fund certainly works, is when we had the unit price adjustments in the COVID-19 crisis, where we adjusted the price downwards because ultimately we had to reflect the actual value of the unsmooth fund. A lot of clients felt it quite hard, although they thought, why did it fall by so much? And effectively, it didn't fall by as much as the unsmooth market, say, the multi-asset sectors. However, with the multi-asset sectors and unsmooth funds, if you've got a falling market, you're sort of being nudged down every single day. So you get used to that feeling of, oh, I've lost a bit more today. Oh, I've lost a bit more today. Oh, I've lost a bit more this week. Whereas with Proof Fund, because we do monthly or quarterly checks, then you get the hit in one. So you get that larger hit and it's all in one go. And sometimes that can feel uncomfortable to clients. So again, it just goes back to that question you just asked, what should clients be mindful of when investing in Proof Fund? It's just letting them know that, when you do get a unit price adjustment, either up or down, it will feel quite different to how your other multi-asset funds would feel, because you get that daily fluctuation.
Yeah, definitely. Makes sense. Finally, was there anything else you think people should know about smoothing that we haven't sort of discussed in this conversation?
Sure. So I think clearly we are not the only providers of smooth funds out there. There are other types of smooth funds. I think the key to a good smooth fund is obviously that smoothing formula that we apply, but the real strength in smoothing is the underlying assets themselves. If you have a poorly run fund and you add smoothing on top of it, you're still potentially going to get a poor outcome. You need a really well-run fund, good diversifications, good multi-asset fund, and with the overlay of smoothing, that can provide you with a better outcome to clients. So yeah, that that sort of the formulaic process that we apply works, but it only works because the underlying fund itself is one very strong, very well run, and very well diversified, which helps when you have market volatility like we are suffering just now.
Yeah, so it's not a sort of cure for a bad fund, but it works well with a good fund.
Exactly, yeah.
Cat, thank you so much for joining me. It's been really great to talk to you today.
Thanks very much.
Thank you so much for listening to our podcast about investment smoothing. If you'd like to see more about investment smoothing, do check out the special report we did with Prue in the September issue of Money Marketing and on our website. Tune into next week's podcast, where I'll be speaking to Colin Simmons, Business Development Manager at Prue, about retirement planning. Also, do make sure you keep up to date with all our content on the Money Marketing website, as well as Twitter, LinkedIn, Facebook, and Instagram.